Okay, everybody, today's topic is PMI, or private mortgage insurance. This is an interesting topic, at least from my perspective, but I found that there's a lot of disinformation out there about what PMI is, and it gets a bum rap sometimes.
Yes.
Here to illuminate us and to get us on the right path is none other than Beth Larson with Essent Guaranty. Fun fact, Essent Guaranty is one of only 6 PMI companies in the entire country, and we are so fortunate to have you with us today. Beth, how you doing?
Thank you. I'm good. Thank you. Thanks for inviting me.
Awesome.
Great to see you.
Tell our viewers here, what is PMI?
It's private mortgage insurance, also known as MI. And it allows you, a lender, to offer a mortgage with less than 20% down on a mortgage.
On the value of a new
home. Yes, thank you. Thank you. A little tongue-tied there.
Yeah, awesome. No, of course, this is an insurance policy, but who's the beneficiary? Who actually reaps the benefit from? Who's that policy there to protect?
It protects the lender. Yes, it does protect the lender in the event of a default.
Okay, if you don't make your mortgage payments,
yes,
and the mortgage company incurs a loss, the mortgage insurance policy is there to help the lender, protect the lender against a potential loss if you default on your payments.
Yes.
Here's another interesting thing about mortgage insurance, or MI, is that there's 4 different types of MI. The most common one is, of course, the one that's in your monthly mortgage payment. It's that little line item. You get your principal, interest, your taxes, your insurance, and then there's a little line item for
mortgage insurance.
For mortgage insurance, right? So let's just go into what are the 4 common types.
Okay. Well, Essent offers the 4 most common types of mortgage insurance, and that would be borrower paid monthly insurance, borrower paid single premium insurance, and borrower paid split premium insurance, and then there's lender paid single insurance, premium insurance.
And you know, knowing these types of policies, and your loan advisor, as loan advisors, we can help you determine the one that's going to be best for your financial goals. Like I said, the most common one, the one most people know about is the monthly. That's the one that, again, is a one line item in your monthly payment. The single premium, that's where you pay a single lump sum at the time you close the loan. It can either be paid out at closing, or if you're refinancing and there's enough equity, sometimes it can be rolled into the loan amount of the new loan. And that over time can save you a lot of money, but over time. And then the split premium is a hybrid between the first 2. So it's for the upfront portion of it, it's an upfront plus your monthly. So the upfront portion is a little less than the standard upfront, and then the monthly is a little less. So you're kind of balancing those 2 off. And then the final one is the lender paid policy, and that's where the lender builds the cost of the policy into the pricing of the new loan. So they would, in most cases, they would raise your interest rate up a little bit from what you would have had, but that way more of your payment dollar goes towards the principal interest portion of your payment, which can actually help you on your tax strategy, and we'll talk about that in a little bit. So one of the things that actually comes up during a discussion with most of my loan applications that have mortgage insurance on them is how much this is going to cost me, right? Okay.
Of course.
So it is an insurance policy, and there is a pricing methodology to it. There are many different types of attributes and things that go into it. In 2019, though, most mortgage insurance companies went with something called a risk-based pricing model. That takes into consideration several different factors and the overall risk that the lender is taking for the loan application. Some of these include your debt-to-income ratio, your down payment, your loan versus value, or your loan to value ratio. Sometimes we call it LTV. So what are some of the common things you can look for?
Well, Derek, there's many attributes that go into the cost of the MI, and those being your loan amount, your credit score, and the value of your home, for instance.
Awesome. So one of the things that actually comes up, one of the misnomers about PMI, and I know a lot of people have been told by their parents, so my parents are like, don't get mortgage insurance, don't get PMI, it's a waste of money. Not always. Interestingly enough, PMI has been tax deductible since 2007. All the way up until 2017, it was actually a tax deductible item until Congress decided not to renew that, and all the way up until this year, they have still been weighing whether or not to bring it back. But currently, you need to always, you know, anytime you're talking about something tax related, we always want you to consult your tax advisor to make sure you keep up on the current laws, because they do change whenever Congress changes its mind. All right, and now the part of the video you've probably been waiting for: how do you cancel PMI? Okay, so if you have the borrower paid monthly premium, which is the most common type, the good news is there's two different types of ways you can cancel it over time. It is insurance. It is an insurance policy, and as such, it is actually governed by a series of laws created by Congress, and it gives you two different paths to remove it. So let's talk about those two ways. What's the most common way, you know, to remove this?
Well, it's protected by the Homeowners Protection Act of 1998, also known as HPA.
Yes.
We just love all those acronyms
in
our business. So yeah, but it is the Homeowners Protection Act, and the first way is that once your loan to value reaches 80% based on your original property value.
Original property value.
Yes.
80% of your original property value.
Yes, and the borrower paid mortgage insurance. Then you can request from your servicer for the cancellation.
So you request it from them.
So that's the first way.
By the way, before you even apply, you need to reach out to your payment servicer, make sure your payments are done on time. I'm telling you, if you're asking a lender to remove an insurance policy, if you haven't made your payments on time, you're probably not going to like the result of that conversation.
They're not going to approve it, yeah.
All right, so what's the second way?
The second way is that, again, borrower paid monthly mortgage insurance, that if your loan to value it reaches 78%, they are required to cancel the mortgage insurance at 78%. If again, as long as your mortgage payment history has been on time, and or if your mortgage is at the halfway point. So in other words, if you've reached 15 years of a 30-year mortgage. So that is the second way.
That's good news. Yeah. So much.
One other caveat.
Oh, okay.
One other caveat. There is. Can we look at this? I need to look at this. Keep in mind, borrower paid MI cancellation under the HPA only applies to MI for single-family primary residences. Some states, notably New York, also have cancellation laws that predate and may supersede the HPA. So it's important to note that lender paid MI cannot be canceled.
A notice from Essent Guaranty's lawyers.
FYI.
So
want to keep it real.
No, we're keeping it real. Yeah. So anyway, thank you so much for joining us today.
Yes.
If you have any questions about PMI, I keep a lot of this information on my website, so you can always head over to unconventionallending.com. I'm Derek Bisson. This is Beth Larson. Thanks so much for watching, and make it a great day. Take care.
Thank you.